joining us today. It's great to have you with us. And today the topic is specifically building credit with a credit card. My name is Sharon Powell, and I'm an educator in the Family Resiliency Program, which is within the Center for Family Development at University of Minnesota Extension. And Sam, do you want to introduce yourself quick?
Sure. I'm Sam Roth. I work in Carver and Scott counties with the University of Minnesota Extension doing financial capability.
Yeah. And so Sam and I both teach classes in like budgeting and credit and debt management quite a bit. And that's what inspired us to do this project. So I'm going to give you a little bit more information. Like I said, just if you didn't hear, this is the first webinar in a series of 5 webinars that have to do with more specific tips and techniques for budgeting primarily. We're going a little far afield today with the credit card, but I'll show you how that links up in a minute. So the reason why we came up with this series is because when we teach classes, or I'll just speak for myself, but I think Sam agrees, when I teach classes about budgeting, let's say, there's a lot of tips or suggestions I give to people, like about, say, tracking spending. I say very quickly, because I'm trying to cover a lot of information in a short period of time, I say, and you could do something like use an online app for tracking your spending. And then I say, here's one I would recommend. And then I say, but there's lots you can choose. And that's kind of it. Or like, for instance, today, when I'm talking with people about building credit, I say a great way to establish a credit report in a safe way is to use something like a secured credit card. But I'm not able to dive in deeper with people really and tell them more about using things like credit cards to build credit. So we were hoping to pull out some of those quickly given tips that we do in a general class and be able to talk with you in more depth about them in this series. So that's what we're doing. Okay, so just to make sure we're all on the same page, I'm showing you this. I call it the budget cycle. It's also called Steps to Creating a Successful Budget. And this is usually, for me, the foundation of my class plan when I'm teaching about budgeting. And so you start up here with set financial goals, and you follow the steps as you go around to know how to create a spending plan or a budget for yourself. So if you're wondering where building credit falls into this, it really falls into this half of the cycle, where setting financial goals, for instance, many people's goals might be to get out of debt. So things like paying off all my credit cards or paying off one credit card by the end of the year, something like that. That's how credit can play a role. Tracking expenses, credit plays a role because often we have large monthly payments due to credit card use. And so we want to try to reduce your expenses if possible by using credit cards strategically. Or preparing a spending plan. Same thing, if you have regular payments that you're making to pay down credit card debt, then that can really influence your plan for how much money you have coming in and then where you're getting to use that spending, basically, to use that income. Okay. So again, to make sure we're all on the same page, credit plays a really big role in our financial lives, and a lot of it is without our permission. It just happens to be the way things are here in the United States. So it can play a role in employment. Sometimes you're not able to get a job if your credit report or your credit, if you have poor credit, or you have things on your credit report. A lot of times you might have to give permission for someone to look at your credit in order for it to be considered for a job. So it definitely plays a role there. It plays a role in housing because it influences the type of loan you're able to get if you're going to purchase a house, and it influences whether or not maybe someone will rent you an apartment if you're a renter, or how much they're going to charge you for security deposit, for instance. They'll take a look at your credit score and make decisions based upon that. It also influences transportation, again, by what sort of interest rate you're able to get when you take out a loan to purchase a car. But also, your credit score will impact your insurance premiums. So the better your credit score, the lower your premiums will be. And then also there's things like getting a cell phone. I mean, I'm sure if you've ever purchased a cell phone, they'll do a quick credit check on you right there. And then it can determine whether or not you're able to take out a certain kind of contract or what kind of plan you'll have, that kind of thing. So all of this stuff is influenced by credit. So we want to try to help people be aware, first of all, and then use strategies to make their credit look as good as possible, because a lot of it is just really a way of presenting yourself to lenders. That's really what credit is all about. And so there are things you can do to make yourself look your best when you are putting your stuff out there for lenders. Okay, again, I just want to show you this little thing. I'm a financially person and a nerd, and I love mortgage calculators, all kinds of financial calculators. So there's one I can do that looks at how much money you wind up paying over the life of a loan based upon your credit or your interest rate. And so this is just one more thing I try to convince people that it's really in all of our best interest to make our credit scores go as high as possible, because that influences what interest rate we can get. And so if you were to imagine that you wanted to take out a $7,000 loan to buy a car, let's say like a used car, and you're going to pay that loan back in 48 months or 4 years. Only banks think about things in terms of months like that, I think, but it would be a 48-month loan. Then let's look at how much money you would pay over the life of the loan based upon your interest rate. So if you were able to get an 11% interest rate, first of all, your monthly payment would be $181 a month. And over the life of the loan, you would wind up paying $1,684 just in interest. So the total amount you would pay would be $8,684. If you had a 7% interest rate, you would save yourself basically $630-ish over the life of the loan. You'd pay that much less in interest. And if you were able to get a 3% interest rate, then you would save yourself over $1,000 in interest. So over the life of the loan, you'd pay only $437 in interest. So only that much above what you initially took out. So it's really a great savings. And, I love helping people figure out ways to have lower interest rates so they can pay less money overall. Okay, so now to the question of the day: how to use credit cards to build good credit. So first of all, what I recommend to people is that you think about credit cards as a tool that you can use to improve credit. So don't think about it as much as like a way to extend payments or to have access to money that you don't currently have. Those things are all true, and that's the way credit card companies, draw us in to say, oh, you can have these things without having the cash to pay for them. And that's true, but you can get yourself in financial hot water pretty quickly if that's really how you think of your credit cards in terms of a tool. You want to think of it more as a tool to improve your credit. And so what that means is you have a very structured plan for how you're going to use that credit card. And then over time, you'll see your credit improve, because credit card companies report your activity to the credit bureaus, and the credit bureaus store information that is then used to create a credit score for you. So you want the information that gets reported to the credit bureaus to make you look like you are a super payer, that you're responsible, and that you're somebody who takes care of your bills. So the way you can help use your credit cards to improve credit is to, first of all, pay your bills consistently and on time. Make sure you get them in there before the due date. And it's really great if you can pay your bills in full, because you get charged interest on the amount of money that you have sitting on your credit card. That's called your balance. So it's great if you can pay it in full. But if you can't do that, still just pay your bill on time. Because if you don't pay it on time, then you get reported to credit bureaus as being someone who has late payments. And that can really influence your credit score in a negative way. So you want to pay your bills on time. The second thing you want to do is stay well below your credit limit. Some people say only use as much as 10% of your credit limit. More commonly, you'll see people say only have as much money on your balance as 30% of your credit limit. So what that would look like is when anyone takes a credit card out, the credit card company says, okay, you can use this credit card to purchase as much as you want up to a certain amount of money. So maybe your first card might have a $1,000 limit. That's as much money as you can ever have spent using that card at any one time. And that's called your credit limit. And then when you get the bill, and you make a payment on your credit card, then that money comes down off of your balance and you have more money you can use up into your credit limit. So what financial experts recommend is that, let's say you have $1,000 credit limit. They don't want you to ever have a balance on your credit card that is more than $300, because that's 30% of your credit limit. So you want to watch out for that when you're using a credit card. Again, the healthiest thing to do is to pay that bill in full every month, because then you don't get charged any interest on the way you use it. And so that's the most financially healthy practice, but sometimes people can't avoid keeping a balance sometimes. So I understand that too. Also avoid unnecessary fees. So like I mentioned, paying your bills on time helps you avoid fees. Also things like don't use your credit card to take out a cash advance. You usually get a fee for things like that. There's other examples, but anything that's going to charge you a fee, try to avoid, because that's one way that credit card companies make a ton of money, and it's kind of a hidden profit source for them. They don't like us to know about that, but as much as you can, avoid that. And then, as I said already, if you can, pay more than the minimum payment, but at least pay the minimum payment on time. So these are things you can do to use your credit card as a way to improve credit. Again, you have to stay really focused and kind of ignore all the ways that the credit card company is trying to entice you into using that to buy more things, because what credit card companies want is for all of us to carry a balance. They want us always to be owing them money, because then they can charge interest and make money off of our charges. And so they'll try as hard as they can to figure out ways to help you build up a big balance on your credit card. And so you have to just put your blinders on and stay focused that no, you're not going to listen to the credit card companies. You're going to pay that fee off every month in full if possible. And then they don't actually make any money off of us, but we get a lot of benefit from the use of the credit card. So we kind of turn the tables on them, which I love. I really like doing that to the big financial industry. So anyways, to build credit, another thing you can do is have at least what they call 3 active lines of credit. And what that means is you have 3 different accounts that you're currently using, like you're paying money on a regular basis. So credit cards are an example of a line of credit, an active line of credit. And if you have no credit and you want to start building credit, you could even take out, say, 3 credit cards, though I think it's better if you can kind of mix things up a little bit. But other examples of active lines of credit might be if you have a home mortgage, that would count, or a car note, that would count, student loans, anything that you've borrowed money from and then you're actively repaying usually counts as an active line of credit. I guess, Sam, are there any questions? I feel like I'm just running.
Yes, there is. Somebody asked, so if you have lots of activity on your credit card and you constantly push the credit limit, you should call them and ask them to raise your credit limit.
Oh, yeah, that's a good idea. I mean, if you're somebody who they are like, oh, wow, you're a valuable customer because you're using it a lot and everything, they'd probably do that. Usually they sometimes will even I just got a note from somebody that they raised my credit limit because I guess they hope we'll spend more and then owe them more too. So that's a great idea. Yeah, they're pretty willing to work with you.
Is that if you're constantly pushing the credit limit and not paying them off, increasing your credit limit might also increase your debt and the amount that you owe in interest rate. So, we want to make sure that we're making wise use of our money as well.
Yeah, that's a really good point. You could possibly just get yourself into more debt that way. Mm-hmm. Okay, so practicing smart credit card use. I just told you all the stuff about, if possible, pay bills in full, pay them consistently and on time. If you're like me, it's sometimes hard to resist the temptation to use my credit card when I have it sitting there and there's something that I really want to buy, but I don't have the money for. So I have a picture of a freezer on this slide. And when Sam and I were waiting to start this, I said, Sam, do you know I have that freezer on there? And she's like, oh, yes, I do. Because in the financial industry or the financial education field, we have this example that I learned a long time ago about using credit cards wisely by only spending them, using them to make certain purchases that you know you're going to be able to pay off, and never going outside of that plan. So one way you can really practice smart credit card use is to choose one affordable regular payment, usually per month. So it could be something like, if you want to fill your, now that's probably not necessarily affordable, but in the past you could fill your car with gas one time a month and use your credit card to pay with that for that. Or if you have young children, you could buy diapers once a month with your credit card. Or you can even put like a regular payment on your credit card, like if you subscribe to Netflix, you could pay for that with your credit card. And then, so you have that one payment that you're using that credit card for. Then when the payment comes, the check or the bill comes in, you pay it in full, pay the whole thing off. So like I said, you're not owing any money. You don't have to pay any interest on that charge. And then you don't use that credit card for anything else. It's the one thing. And then what that winds up doing is making that credit card look like an active line of credit, because it is, but you're using it in a way that you can afford to pay in full every month. So you're getting the benefits of having paid in full on an active line of credit, and they'll report that to the credit bureaus every month saying, yep, they paid in full, their balance is zero. And so that actually, in a pretty quick period of time, will start to show benefit to you by raising your credit score. And then the other thing is, like I said, you don't wind up don't have to pay anything extra. This is just all, basically you're using it in the same way you would use cash, but you get this added benefit to your credit score. The trick is not using the card for anything else. And I will say I struggle with that. And so what the kind of the tip that I've heard in financial education circles throughout this time is that you, in order to help yourself not use your credit card, that you basically take that credit card when you're not using it, you put it in a bowl of water, and you put the water in the freezer. And so it means that you basically freeze your credit card in a block of ice. So if you want to get to that credit card, there's this delay. You have to wait for the ice to melt before you can get to that credit card and use it. And oftentimes, if you do that, it helps you kind of get through the impulse to use it, and then you can stay strong. Stay strong. Okay. Anything else in the chat that I should address right now, Sam?
There's a question: is it true that not all banks report to the credit bureaus?
I think what is definitely true is not all banks or credit unions report to all three of the credit bureaus. I would be surprised if a bank or credit union now didn't report to at least one, but you should definitely just ask. That's one of my tips on my slides coming up. Just make sure that they do before you go to the work of taking out a credit card with them.
Yep. And your checking account / debit card activity is not reported to credit bureaus. So if you're referring to banks as in like credit card banks, they would report to the bureaus, but some report monthly, some report quarterly, maybe bi-monthly. So they're not always going to be coming through the credit bureaus at the same time. That's why you'll see a difference in your credit report or scores because of that. The other question is does it hurt your credit to have a card that expired? So this person had it connected to their auto pay for their student loans and nothing else, and they didn't pay for 2 years during the pandemic because of the student loan freeze. Forgot about it and doesn't have any activity on it for 2 years.
So the card did actually expire, or did they just send you like a new one? We'll find out.
It actually
I
expired.
guess. Okay. So I think in general, it's not a good thing to close credit cards frequently, which is why it's really important to think carefully about if you really want that credit card before you take it out, before you open an account. But I think in that case, and if part of closing a credit card means you have less access to the spending power of whatever that credit card brought you, which is one reason why, again, financial education experts recommend that you have more than one credit card open, because it gives you more access to spending, which within reason looks good on your credit report and it boosts your credit score. So if that was like your only credit card and it expired, it might, bring your credit score down a couple of, or some 10 points or something like that. Um, but it sounds like a pretty good reason. And I wouldn't say it's like the end of the world. If you want to get a new credit card, you can probably remedy whatever,
Yeah.
downturn happened.
Yeah. It's not going to be super detrimental, like being 3 months late with the payment.
Yeah.
Another person said, and I like this comment because it refers to the freezer. In this day and age with online shopping, I think that it's hard to put your card in the freezer. True. Because most of the time it's just automatically tied. Many people can save their credit card info online with places they frequently shop. And that is true. However, just I'll take this one, Sharon, if you're okay with it.
Go for it.
You can freeze or lock your credit card on a credit card. Like if you have a credit card and you use their app, you can lock it so that it is unable to be used. And I recently did this to one of my cards just to try it out. And I forgot that that was the one that was tied to like my Apple Pay, my like Amazon Pay, like every pay I have, that card is tied to. And so I tried to purchase something and it said like denied. And I was like, wait, what? And it was because I put the lock on it. And so for me to purchase that thing, I had to go unlock my credit card and then come back. And I was like, I don't really need this, I guess. It was kind of that like moment for me to pause. So you can kind of put it in the freezer by doing that as well.
Yeah, like there's other ways. There's always I mean, you have to know your weaknesses. Some people are just rock solid about not using their credit card unless it's part of their plan, and they don't need any kind of ways to make it more difficult to use credit. But other people like me, for instance, I said, I can convince myself sometimes that I definitely need something when I actually really don't. And so I have to come up with some kind of barriers usually to slow me down a little bit. So definitely, yeah, unfortunately, in today's technology age, the old freezer thing isn't the only thing that'll slow us down, but maybe there's other things like freezing your card, or even just, at some point, maybe you can create your own kind of mental pauses about, do I really need this? What if I waited till a week from now to buy it, and then see how you feel? There's things you can do like that. But it's a really good point that you have to really, really stay on the defensive when it comes to using plastic, because it becomes easier and easier.
Yeah. I'll answer the other ones in the chat, just so that we can keep going.
Okay, yeah, I know credit stuff. We always get so many good questions. Okay, so I wanted to specifically tell you, I was sort of thinking about people who were trying to establish credit or who maybe are trying to repair credit. I wanted to tell you about getting a secured credit card. I don't know if everyone's familiar with those. So the definition is right here on the screen. A secured credit card is a credit card tied to a savings account you hold at the same bank or credit union. So it's called a secured credit card because of that savings account that you hold, which acts as kind of like a security deposit for your credit card. So usually credit is referred to in the financial industry as unsecured credit, because you can basically take out a loan from the credit card company by using your credit card without having collateral, to back it up. You don't have to check in with them and say, hey, if I make this big expense, you guys can have my car if I don't pay you back or whatever. You can just use the money. And so a secured credit card works more like a typical loan, in that you have to have some money in there to back up whatever expenses you're making. And that makes it safer for people who are new to credit or who are trying to repair their credit. So the way it works is like this. First of all, you want to make sure your bank or credit union offers secured credit cards. You can just ask them. Most of them do. And then if you decide that's what you want to do, you need to have a pot of money that you're going to deposit into a special bank account for the secured credit card. So you open a secured credit card account. And as we already said, one thing besides having the secured credit cards is you want to make sure they report to the credit card company, the credit bureaus, even if you have a secured credit card. So again, most do, but it's just a good idea to make sure, because that's the whole reason you're doing this, is to improve your credit. And so it needs to be reported to the credit bureau. Your activity needs to be reported. So then you open a secured credit card account. Then you take that money that you have saved up and you put it in the special bank account. Usually there's a minimum amount of money you have to put in the account. I've seen it as low as $250. $300 is something I see. So you need to have at least around that much to deposit in the bank account. And that amount of money becomes your credit limit. Whatever amount of money you have in that bank account is what is the credit limit for your card. And then you begin using your card with this special strategy in mind, the one I just mentioned about choosing one affordable payment per month that you then pay off in full every month. So I have a little picture here that I tried to draw, and now I'm going to try to get fancy and write on the screen. So let's see how that works. What happens if I close this? Is it still my, oh, okay. So I don't know if you all can see, but I have this little like bar thing that's in the way. Okay, so as I said, you will go into this bank and you will open a special account that is where your security deposit essentially for your credit card will live. And so I have it over here and it's $300. And this is a bank account that's a separate account from your regular bank account that's there. And that's this one over here where money flows in and out. So, you know, like it's your checking account, let's say. So that's got money coming in and out. This one just sits here with this $300 in it. Then you get your card and you use it for that one affordable payment, like, you know, Netflix account, let's say. So you get like a $20 bill in the mail, and then you pay that bill in full, but you pay it from this regular bank account. And then you just keep on doing that. The reason why we want you to pay the money from the regular bank account and not from this the security deposit account is because if you were to pay from this account, then that money will be subtracted from whatever is in there, obviously, and that will make your that will make your credit limit go down. So if you paid $20, then next month you would only have let's see if I can draw, $280 in here. Oh, Lordy. There we go. And so then you'll just have less of a credit limit. So we want to keep this credit limit higher, and then you use the money from your regular checking account. If you, for some reason, forget to pay the bill, the nice thing about this is that it will get paid for you automatically from the bank. They'll just draw the money out of your secured credit card account, bank account thing here. And so the money will go down. So it's better if you can pay it from this one. But if you forget, you still will look like you're paying on your credit because they'll do it for you automatically. Okay, any questions about any of that? I'm going to clear my beautiful drawings. There we go. Okay, so then the other thing about secured credit cards is if you do that, take out this one monthly payment for like even as little as 6 months, you will begin to see an improvement in your credit score. Or if you're establishing credit, you'll begin to have a credit score, which is great. So then the thing is, if you don't like having your money tied up this way, like this security deposit money, if you do this secured credit card for say 6 months to a year, usually your credit will have improved to the point that you could get a more traditional credit card that would allow you to not have to put your money in a security deposit like this. Were you going to say something, Sam? No? Okay.
Nope.
Okay. All right. Oh, here's what I just said. I forgot I have this. So over a relatively short period of time, you'll begin to see your credit score climb, which is always nice thing about credit is that it is really relatively responsive. So it doesn't take that much time to see a change. And it feels nice that way. It's gratifying to see your efforts have a reaction like that. Okay, Sam already mentioned this, but just keep in mind, because it's confusing. Again, I'm thinking of actually my own sons who are 20 and 17, and they are quite confused about all of this stuff. But keep in mind, debit cards do not build credit. Like a bank card that's just like access to your checking account, it looks just like a credit card, but it is not a credit card. So your activity, whatever your financial activity is that's linked to your checking account and your savings account, does not get reported to the credit bureaus. You have to have a more traditional type of credit card where you're actually using someone else's money and then you're repaying that money in order for that to be reported to the credit bureaus. That's all credit bureaus deal in, is money that we are repaying. And so nothing like paying your utility bills, paying your rent, nothing like that will ever be reported to the credit bureaus unless you get behind and it goes into collections. Unfortunately, then it might get reported. But if you're paying your bills on time, those kind of expenses do not get reported. It's only people that you owe money to that you're repaying. Okay, now I'm officially at my question slide. What time is it? Oh, it is 12:45. Okay, any
Yeah.
quick last questions?
So we had another question. Is it detrimental to your credit score to pay off credit payments a day of or shortly after the purchase?
Yeah, people wonder about that. Like, what do you think, Sam? Like, they're like, it doesn't have a chance to be recorded on the thing. Like in the older times, it was like, wait till you get your bill that has it on there and then pay it in full.
Right. That's yeah, so the whole FICO score, credit bureaus, how everything is determined is like this one of the biggest mysteries of the United States. It's a well-kept secret, and there are more scores. The Vantage Score 3.0 has come out, and I'm sure other companies will come up with their own as well. So I really don't know how to answer your question, Casey, correctly. I think it depends on the company, the credit bureau, exactly how long. I mean, it's okay. It's always good to pay off when that bill comes, but you're right. Like you don't want to forget about it later, or you don't have it automatically set up, or, sometimes maybe setting a reminder 2 days before it's due would be more beneficial, but I don't think it's detrimental. I just don't know that it's going to affect it or help it, hinder or help either way.
Yeah, I mean, in some ways, I feel like it must help because when you go back and look at the transactions, they'll always be on there, regardless of
Mhm.
the frequency with which you pay them. And so there has to be a record of that, you know?
Right.
So I feel like that rule was a little bit more, um, it was easier to figure out prior to like online banking and
Mhm.
having apps that allow you to pay so quickly and that kind of thing. But it is a little bit still a mystery, I would say. Yeah.
Yeah. Yeah. And we did have somebody ask about like how far back does your credit history go if you have late payments and stuff.
Yeah.
Um, and I just responded that your credit history does go back for 7 years, and then bankruptcy is 10 years. However, obviously, the more late payments you have, the more it affects your credit score and your credit history. So it's also good, even if you have late payments that, are from 3 years ago, you're now showing that you have been responsible and paying them on time. We always say, like when we're budgeting, to make sure if you have credit card debt to make that minimum payment, because that really does affect your credit history and score.
Yeah, that's right. And the thing about the 7 year time frame is if those loans get sold to someone, like let's say you're in default and sometimes defaulted loans get sold in big bundles to another company and then they start trying to collect on the loans, then that 7 year time frame will start over again for you. So it's whoever's the owner of the loan that starts that 7 year clock. So just because it was 7 years ago that you initially used it, it doesn't mean it will necessarily come off of your credit report. And that's all. We won't go more into credit, I guess, right now because we were trying to
Yeah.
narrow in on these little things and it's time to go. But Sam's putting in the chat some just general resources that we wanted to share with you about credit cards.
Yep. And we just want to invite you back. Next week, we are doing on how to, what are we doing? Budgeting with a calendar system. And so we'll be talking about how to use that. So we're focusing on 3 different ways to budget, using a calendar system. The week after that is apps or Excel. And the week after that is an envelope system. And then we'll wrap it up with plug in your spending link. So if you find yourself often short at the end of the month and figuring out where is your money going. And yes, these are all going to be recorded and will be sent out at the end of the Thrifty Thursdays series. So you'll actually get all 5 of the webinars from the Thrifty Thursday series. There we go. So
Yeah, and we'll send you did you just say this, Sam? We'll send a follow-up email to all of the registrants with these resources and things like that too. So
yeah, and we don't send the chat out, EJ, but we'll include the resources in that email. Sherry and I will hang out for a little bit more. If you have more questions, feel free to put them in the chat. If not, thanks for attending today.
yeah, great to be with you today. So hope we'll see you next week too. Bye. think the 30-minute format is good.
Mhm.
Just get in there and do the stuff, you know.
Oh, yes, we will include next week's class registration in the follow-up email.
Good idea. How many participants did we have at one time, do you think? Did you notice? Oh, are we still recording? Can we turn that
Oh
off?
yeah, we should stop recording.